Okay, so we had mentioned before that there was a market for dollar deposits outside the US called the Eurodollar market. Thanks to the regulations imposed by US regulators, many such innovations in the banking industry were created to bypass these regulations. Banks outside the US accept dollar deposits since they are not subjected to regulations on deposit rates or reserve requirements and hence can offer better rates. These banks that participate in the Eurodollar market are called Eurodollar banks and are primarily London banks. Due to increasing regulations in the US, there was a growing demand for placing dollar deposits outside the US. At the same time, the dollar was replacing the pound as the international currency for trading, with the pound devaluing rapidly. The post-war monetary system, Second World War monetary system, moved to dollars from the pound, and most countries kept their reserves in dollars. Because of the regulations in US, many countries wanted to hold dollars, however, not in the US. This opportunity was a blessing for London banks who started borrowing and lending in dollars. The London banking sector came to be known as the Eurodollar market. So let's take an example again of how this works to understand this better. Now assume that IBM US wants to make a $10 million Eurodollar deposit with JP Morgan in London. IBM will issue a $10 million check drawn on its US bank Wells Fargo. When the check clears, the effect of the bank's balance sheet will be as follows. So in the Wells Fargo bank, the checking deposit of IBM is reduced by $10 million. The liability is debited by $10 million. And the checking deposit of JP Morgan is increased by $10 million. So the liability is credited by $10 million. Now the asset of JP Morgan London. So since Wells Fargo US Bank has created a checking deposit, which is basically a borrowing from JP Morgan London, JP Morgan London's assets increase by $10 million as a deposit at Wells Fargo US. So this is what JP Morgan London owns. It's a loan to Wells Fargo US. And since it's an asset, you debit the asset. It's an increase in the asset. And the liabilities, which is the deposit that IBM places on JP Morgan London, a time deposit increases to $10 million. So we can see that these are all book entries. There are no physical dollars that have left the US. The ownership of $10 million deposits of IBM at Wells Fargo have been passed from IBM to JP Morgan London. IBM has converted this checking deposit to a time deposit in Eurodollars at JP Morgan London. So we need to understand that these are all book entries. No physical dollars have left the United States. The ownership of $10 million deposits of IBM at Wells Fargo have been passed from IBM to JP Morgan London. IBM has converted this checking deposit into a time deposit in Eurodollars at JP Morgan London. Now, JP Morgan does not earn any interest on the deposit with Wells Fargo US and needs to pay IBM on its deposit. Therefore, in order for the London banks like JP Morgan to make money, it needs to lend the dollars. Assuming that it lends the dollars to Apple or places these dollars in the interbank market overnight or in term deposits, JP Morgan would earn interest on these deposits. Let's take a look at how JP Morgan makes a loan to Apple and what the balance sheet would look like for JP Morgan's bank. So on the asset side, the deposit at Wells Fargo US is reduced by $10 million. And since it's a reduction of an asset, you would credit the asset. The loan account with Apple is increased to $10 million. And since it's an increase in the asset, you debit the asset. The liabilities plus equity, the time deposit to IBM remains the same at $10 million. The time deposit of IBM remains the same at $10 million. It's a liability for JP Morgan. and that's untouched with this loan. Now, since these are Eurodollar funds, JP Morgan needs to make the loan by writing a check on its deposit at Wells Fargo US. The Eurodollar banks in London are not allowed to offer checking deposits on Eurodollar in dollars. If the Bank of England allowed deposit creation, it would increase the money supply in the UK without any actual dollars flowing in. Now, assuming that Apple banks with Citibank New York, where it deposits the check, the balance sheet of Wells Fargo and Citi would be affected. So, Wells Fargo Bank US, on the asset side, the deposit of Wells Fargo at the Fed would be reduced by $10 million, and the checking deposit account of JP Morgan would be reduced by $10 million. Citibank's balance sheet would be affected when the assets increase by $10 million, which is the deposit at the Fed, and the checking deposit of Apple increases by $10 million. So we see that the London banks act as intermediaries for Eurodollars. All dollar transfers made between the US banks are made electronically and not through checks. So no transfers are made outside the US, and therefore Eurodollar banks depend on US banks to effect the payments. So we can summarize our understanding of the Eurodollar market as a market that basically emerged due to restrictions and regulations on deposit rates, lending to foreigners, deposit insurance premiums, and etc. Due to the disadvantages faced by the US banks, many regulations were eventually dropped. However, the Eurodollar market continues to flourish to date as it provides US banks an opportunity to move some business offshore beyond the regulator's reach.